Let's talk about the basics of getting out of debt. This is going to be very simple. If you know all of this, skip this video, but we're going to start with some simplistic ways of analyzing what you should do. In other words, what you should pay off first. You probably have heard all sorts of business terms, but you should apply them to your personal finances, like a balance sheet and cash flow statement. There's all kinds of ways to look at these things, but balance sheet basically says how much stuff do you have and how much stuff do you owe. If you could sell all your stuff and you would get $100,000 and you owe $20,000, just subtract and you're essentially worth $80,000. Now you might be surprised, look at it and realize you're less than zero, bad situation. But let's talk about cash flow. Cash flow is real simple. How much money do you have coming in? Maybe after taxes, you have $4,000 coming in on a monthly basis. How much money is going out the door? What are you paying for a home, mortgage, or rent? What are you paying for a car? What are you paying for insurance, electricity, all those things? Now, no reason to be overwhelmed and jump online to some website where you're going to have to enter this information in and hook it to your bank accounts and go, forget it. Just grab a piece of paper and write these things down. You'll just have to do it once to get started or use a spreadsheet, but you need to know how much is coming in and how much is going out. Obviously, you want to make sure that you're not spending more on a monthly basis than you're bringing in. Let's say you aren't. Now, what do you pay off first? You've got potentially a mortgage, car loans potentially, personal loans maybe, credit card loans. I'm going to show you the difference between something like a credit card loan and a car loan, because it is substantial the amount of money you're going to end up paying on some of these high interest rate credit cards versus a car. It is phenomenally different. So I'll show you an example coming up here of exactly how you should write these things down. Just think about all your different bills, maybe grab a couple statements, on average, see what they are in a month, and then pick the one, probably the credit cards, if you've got a balance that you need to pay off first, and you'll see how much money is being wasted, meaning there's interest payments as well as principal. What does that mean? Well, if you owe $100 on your electric bill this month, you pay them $100 and it all goes to the electric bill. But on a loan, when you make that $100 payment on a monthly basis, if there's a percentage rate for the loan, part of it is going to go to what's called principal, and part of it's going to go to what's called interest, and the interest is just gone. It's useless for you. That's why you want to get rid of them. It might be a $100 payment. It might be $60 going to principal. If you owe $1,000, that $100 payment's only going to pay down $60. Now you owe $940. And the other 40 is going to interest. That's just profit for the bank or whoever you happen to have gotten a loan for. So I'm going to show you really quickly how to write these things down. It's worth doing. It's very basic, but you'll never make changes in your finances or wipe out any debt if you don't have things written down so you can look at them and quickly determine what you need to take care of first. All right, so let's take a look at just a basic cash flow, money in, money out. You've got a job, let's say after taxes, it's a clean $4,000. Just look at how much you've got on your monthly or bi-monthly statement, or just look at what they put into your bank account and see how much money you have coming in. Let's just say you've just got one job, that's your only stream of income. Then you've got, let's say, rent of $1,000. You've got a car payment. I'm going to give you an example to show you the amortization, but let's say your car payment is $483.32. I'll show you why in a moment. Utilities, streaming service, gas, water, let's say it all adds up to $350. And then you've got a food budget, I don't know, $500. You probably have some other things in there. Let's just go with that. You get the idea. You've got your revenue, then you've got your expenses. Now, let's look at credit card debt and a car loan. So first off, we've got a calculator here online. They're real simple, just loan amortization calculators. Why are we doing this? Let me show you why. First of all, let's say that you've got a $25,000 car that you purchased. That's what you paid for it. Interest rate, let's just use 6%. Maybe it's a new car. Maybe you just got a good loan rate. It all depends. 60 months, that's pretty typical. That's 5 years at 12 months a year. That's 60-month loan term. It starts, you calculate, and it tells you, all right, your monthly payment is $483.32. Now, this type of loan means that if you pay that amount for that many months, you'll be at zero balance. You won't owe anything back. Makes perfect sense. Over the life of this loan, it costs you $25,000. You're going to pay total interest of $4,000. So you're actually paying $28,999. You're actually paying $29,000 for this $25,000 car. So to be able to pay it off over 60 months, it's going to cost you $4,000. All right, so we'll put that in the sheet. That's what you're paying off. Now, when you look at what's called amortization, what does that mean? It means that out of your monthly payment, interest is $125 and principal is $358. $358 is actually going to pay down the loan. $125 is just gone. Someone's getting it, a bank or whomever servicing your loan. Now, as you can see, the first payment has the most interest, and then it goes down, less interest, and the amount of principal goes up. But let's just use this for the first month. We'll put that on the sheet so you can see how much money you're just essentially losing by having this particular loan. Now, let's look at debt for a credit card. I think the last study I saw was around $10,000 the average American has. So we put in here, calculator with $10,000 credit card balance. Let's say the interest rate is 21%, not atypical. Let's just say that on your statement, it says you only have to make a minimum payment of $200. When you click to calculate, you can see what does that really mean? Well, in this case, $200 monthly payment is going to take 120 months to pay off. That's 10 years. $10,000 is going to take you 10 years. That's incredible. On the car loan, it was $25,000 and it only took you 5 years. That's why credit cards are so dangerous, because they have a high interest rate. Now, what does that mean over time? Total principal, $10,000, meaning you paid off your balance at this $200 monthly payment. Interest, you paid $13,972. You paid a total of $23,972. I'm sorry, $23,972. That's absurd. You paid more than twice your actual debt. Now, if you look at that in a loan amortization, your $200 monthly payment, what does that mean? So here it is, $10,000 debt, 21% interest rate, 120 months, which is 10 years. That's what it said on the other page. $200 payment, essentially. Interest, $175 of the $200 payment. Principal, only $25. For your $200 payment, you're actually only paying down $25 and you're losing $175. So hopefully you can see why it's so obvious that when you look at your various types of loans, like a personal loan, a car loan, a credit card loan, the credit card loans can be absurd in terms of how much money you're basically throwing away every month. And over time, that $10,000 of whatever it was you happened to have purchased ended up costing you $24,000. Imagine that. That means if you bought a pair of shoes for $100, you're actually going to pay $240 for those shoes. That shouldn't make you happy. So now you know, and now you can see what you want to pay off faster. Because of that, you want to make sure that not only do you pay it off faster, but you want to get rid of it in order to pay it off faster, by increasing what you're paying per month. Because the more you pay per month, obviously, the faster it's going to go and get paid off. Let's say that 200 was 400. Somehow you earned another $200 a month, or you got rid of some other expenses. Let's see what that did for you. Oh my goodness. At a $400 monthly payment, it's only going to take you 34 months to pay off, not 120, right? So that's less than 3 years instead of 10 years. And your total interest is only $3,266. Look at what a difference that is. You found an extra $200. Now, I don't know what you're doing, but if you've got, let's say, a streaming service that costs $100 a month and you can get rid of it and watch some free online TV, that's $100 you just saved to add to your monthly payment. Make some other adjustments, find another $100, stop eating out, whatever it takes, because you just saved $10,000 in 7 years. That's why, in order to get out of debt, the first thing you need to do, and this was a simplistic video, was write everything down. Everything, just like I showed you, so you know exactly what you're paying, because that's going to motivate you to get rid of it and get out of debt much faster. And then you can start using credit cards to your advantage. I hope you found this useful. Hopefully you found this example helpful and it got you started to figure out what you need to get rid of first and to show you how much money you can save once you get rid of things like the credit card debt. And then you can start watching the other videos and using the cards to your advantage without carrying a balance. Thanks, and please subscribe if you like the channel. I hope you found this helpful.